Hello and welcome. You tune into Rush Hour with me, Ankita Saxena. Well, the Bank of England keeps its key benchmark interest rates unchanged at 4.7%, moving away from the FOMC's decision to cut rates this month. 3 out of 9 members voted for a 25 bips rate cut, but Governor Bailey has maintained his stance for a gradual rate cut. In his comments, he also did not commit to any rate cut timeline or the quantum. But after the anticipated 25 bips rate cut, Fed's chairman Jerome Powell maintains a rather hawkish tone, saying more reductions in borrowing costs now hinge on further progress in lowering stubbornly high inflation. Meanwhile, the bearish sentiment continues to plague the Indian markets as well. Nifty declined for the fourth straight session to close below the 24,000 levels. Broader markets also mirrored the benchmarks, and sectorally, pharma was the only sector that was in the green, seemingly in a bright spot. Well, additionally, the Indian rupee also slid past the 85 mark against US dollar on the back of dollar strength and trade deficit woes. Well, to weigh in on the situation and, of course, the rate cuts and the projection going ahead for the Fed, as well as the impact on Indian equities, we are joined by Mayuresh Joshi, who's the head equity markets. Hi, Mayuresh. Thank you so much for joining us today. Mayuresh, while the Fed has cut rates for 25 basis points, it's the commentary that has really spooked the market. Next year, instead of 4, now there will be just 2 rate cuts. Markets reacted negatively, and there was a big sell-off in the global markets that ensued. And of course, the D Street also followed suit. How are you reading into Fed Chair Jerome Powell's comments there?
Evening, Ankita. So 2 things. One, I think in terms of the expectations of the rate cut, I think it was as per the market consensus. But to a large extent, the market consensus is also the opinion that the tone probably might be hawkish, and it's turned that way. So I think you're definitely expecting to see a pause on how the Fed moves in January. And then probably you might see a token rate cut that might happen on how data points probably work. Now, it's a large unknown on what Trump will do after he resumes office on Jan 20th. Are you going to see a significant amount of tariff wars being played out? Are you expecting to see some elements of corporate tax cuts that probably happen? And therefore, I think the core inflation, which is very, very sticky at this juncture, might be well above that 2% mark that the Fed has probably assumed in its latest dot plot. So to that extent, I think markets might just take this in stride in the next few sessions and then head back in terms of how earnings will play out. So I think the entire pivot for the markets will be on how earnings will play out. And if earnings remain stable, my own sense is that markets will react correspondingly. Similarly, I think what you probably seen in the Indian context, I think the large part of expectations or consensus of the market is there might be a token rate cut with the food inflation expected to head lower in the next couple of months. And therefore, a token rate cut was not ruled out in February. But again, I think how the globe probably moves, what happens geopolitically, if inflation also remains sticky in the Indian context, we'll also have to wait for RBI commentary on how they readjust to the global cycle and the Indian context as well. So yeah, I think the moot point outside rate cuts will be how earnings play out for global markets and how geopolitics shapes up for the next few weeks.
My next question was on that, but in India, the rate cut for the month of February is still being expected, and while the domestic macros warrant it, do the global macros and now, of course, the Fed's hawkish stance really make the decision harder? And what could be RBI's rate cut path for the next year then?
So again, I think what the governor has said, and again, this is what the comments of Shaktikanta Das has been consistently, that they will look at data points and how data points are playing out. Obviously, our own context is the 4% benchmark that we adhere to as a threshold. And therefore, the expectations in terms of a better Kharif output that has come into the market, expectations of inflationary pressures created specifically by food expected to come down, will mean that there will be some element of respite as far as the overall inflation dynamics are concerned. Having said that, a token cut, again, not ruled out, that's the consensus in February. But after that, I think it will be largely how global markets are behaving, how the Fed probably moves, how the European Central Bank is expected to move, how inflationary data points across the globe are moving. And in our own context, whether food inflation is reaching lower to that 4% mark before the next rate cut cycle happens. So I think it all really depends on how data points probably play out. So again, a token rate cut not ruled out. After that, the trajectory really depends in terms of data points that the market will probably throw.
We are joined now by Raed Al-Qadr from Equity Group. Hi, Raed. Thank you so much for joining us. Um,
Hi.
Right, I've been speaking to Mayuresh about the hawkish comments that, Fed came out with and how it spooked the market and what's going to be, RBI's trajectory, after this hawkish commentary coming in from Fed. Nifty usually follows Dow, and now with the negative sentiment, analysts believe that there's another 10% correction that is likely to be possible on Dow, which will continue into the next month as well. What does it mean for Indian markets then?
I'll be focusing more on the global markets here, and definitely it will affect the emerging markets and the Indian market as well. I believe the comments that we received yesterday from the Fed, it's like in particularly the dot plot where it shows less cuts in the next year, 2 cuts instead of 4, as compared to the dot plot in November. I believe that was the surprise in the market, and that was a surprise for the investors as well. And for the Dow Jones, it was already in the downtrend movement, and that news came yesterday. It's make it worse, and sell-off. It was hitting strongly yesterday due to these data and numbers. Specifically, we were talking about the market now. I believe with that hawkish movement from the Fed, with the less interest in cutting the interest rate in the coming year, with the inflation fears sparking that fast within the monetary policy statement, I believe data of inflation came the last 3 months showing that increase strongly, and it shows that worries, but we didn't hear it from the Jerome Powell and the Fed until yesterday, which is considered to be some sort of surprise to the market, and that's why we saw that strong sell-off in the stocks market, not only in the Dow Jones, and I believe it extended to the UT 100 and the S&P 500, and the Russell 2000s was the biggest loser. I believe this will reflect on the global market. It means the inflation story back again on the table, and it's affecting everyone. Strong prices, currency prices, we are saying higher for longer statement. It will stay for a longer period in the coming year, and this is definitely will affect the growth mechanism around the world, and it will affect the money movement back again to those who are providing higher interest rate,
Right.
In general. Yes.
Right, in fact, that was my next question. I'll take a leaf from what you just said. You mentioned 2 things. One is the rising dollar index. In fact, the dollar index hit 108.27 today. It's the highest level in the last 2 years. Inflation is back on the table, and now with Trump's trade tariffs, the inflation is going to only rise. Also, the robust U.S. economic policies that come after Trump is in power, that will also keep the dollar stronger for longer. Going ahead, what are going to be the key? I mean, of course, these concerns are back on the table, but is that likely to impact, the flows, the FIIs coming back to the emerging markets? Because we've already witnessed a lot of selling in India for the last, 2 to 3 months.
Absolutely. Now we have to think about 2 main things, let's say, for the coming period, for the coming year. Inflationary forces might be spark even more with Trump as a president, and more, let's say, limits will be over the trade relations and the supply chains, and this is definitely will make inflation stronger. That's why the Fed is trying to act proactive here and trying to give some room for the interest rate to stay high for longer. And at the same time, we are talking about the second point here, the strong economy in the US. So this correction that we are seeing right now, it's due to the change in the stance of the monetary policy. But in fundamentals, we still see very good results coming from the AI, coming from the technology, the earnings in general doing well so far. We are not seeing lower macroeconomics data coming from the US. GDP just came now and showing the positivity. We are saying that back again to the uptrend movement in stocks in general is there, but replacement now and shuffling in the portfolios, it's happening more. Also shifting to the fixed income instruments with bonds back again to popularity a little bit. We might see it in the coming year. Focusing on the traditional sectors also as well. It will be like a center at the center point. We want, like, I will speak only on the global effect rather than on the Indian, because I'm not that expert in the Indian market. But in general, we are talking about movement still going on towards the higher return assets like the stocks in US, and there is a potential of more growing in the uptrend, but movement tactical within sectors. We might see it more in the next year.
Right, Mayuresh, like Red mentioned that, now the money movement is going to be obviously in higher yielding asset classes. Like, if the interest rates are elevated for longer, then the money could move out, or further movement of money could be seen from the emerging markets. We have already witnessed heavy FII selling as far as Indian markets are concerned. There is the dollar index is rising. There is the geopolitical, the macros. We see a lot of macro headwinds coming in as far as Indian markets are concerned, even though, in India, the story could be intact, but there are a lot of headwinds coming in from, the global players. Moving forward, going ahead now, what could move really the needle of the market for Indian markets? Is it just the earnings growth for India? Or what are the other factors that could really trigger and move the needle for the market?
So I think, Ankita, two things. One, I think obviously earnings remain as a base case scenario for not just the Indian equity markets, for the US markets as well. So how earnings will play out will have a defining scenario in terms of forward multiples as far as markets are concerned. The second element obviously is the government capex that we have been speaking about. So there is a huge expectation on what is probably transpired because of elections. It had got constrained to a large extent. And therefore, in the second half, there should be significant amount of government capex that comes through in the system. Let's not forget, on 1st Feb, as we head into the new year, the budget will be announced. And in my opinion, again, there should be significant allocation that probably takes place in terms of capital spending as well. 11.1 lakh crores last year, that should be increased by at least 10 to 15% as we head into the next year, supporting growth. Let us not forget that Trump has also promised that he will have his own version of Atmanirbhar USA, with a lot of investments expected to come into the US market and self-reliance there as well. And therefore, I think supporting growth through budgetary support is going to be paramount. Obviously, the trigger points that the market will look out for outside earnings and government capex will be how private capex comes back. Because I think that is the third leg that is extremely critical in terms of the overall micro growth that one talks about, in terms of the overall supportive GDP growth. So if private capex starts coming back slowly and steadily, my own sense is that the domestic economy and the consumption patterns that we'll see over the next few quarters should sustain. Flows are sustaining in terms of SIPs as far as equity markets are concerned. And even if FIs probably have some element of resetting done, both in terms of global factors, in terms of the US 10-year, which has reached 4.4, which is obviously crippled a large part of the risk premium that they have towards emerging economies. There will be some element of rupee depreciation because we need to be extremely competitive with other players, including countries like Thailand, Vietnam, and let's not forget China, in terms of our exports, irrespective of what tariffs come through. And therefore, I think all these three factors put together will have a huge say in terms of market. So I think there are sufficient amount of triggers that the market can play with. But the base case, as I said, remains with how earnings play out if markets have to sustain their lofty valuations.
Absolutely. On that note, Mayuresh and Ray, thank you so much for taking the time out and joining us today. We will have to let you go on that note.